Merci. Thank you for having me. Let's start by a little exercise to warm up the room a little bit. Who here is a customer of one of the big 5 banks? You can raise your hands. Who here loves their customer experience? Over there? I'm ready to bet it's an RBC table or something like that. Who here is a customer of Investors Group? Who here is a Wealthsimple customer? Who here really likes the Wealthsimple product? How is it possible that a company that is 3 years old, like Wealthsimple, would have more customers in this room than a customer that is 90 years old, like Investors Group? And how is it possible that the big 5 banks would have a majority of this room as customers, but actually not deliver a product that most people love? I hope over the next hour to convince you of 2 things. One is that we have a generational investment opportunity in fintech, but also in traditional financial services. And 2, that Portage and his partners are uniquely positioned to win in this environment. First, touching on the generational investment opportunity. This slide is so busy, it must be generational. But ultimately, I believe that the opportunity for investment in fintech is driven by one major factor. It's the factor that the risk of being an entrepreneur and the reward has fundamentally changed. The risk of innovation and the risk of company creation is far less than it was historically. And that's because of changes in technology and in the financial services sector itself. Starting with the technology side, the ability to rent rather than buy infrastructure has significantly changed the entrepreneurship equation, where historically it would cost millions of dollars to launch a service like Wealthsimple's. And today it costs nothing but a few $1,000s to launch, significantly changing the capital cost of innovation. Furthermore, and that's, things like Amazon Web Services, Microsoft Azure, all these things are enabling a wave of innovation and a wave of entrepreneurship at very low cost. The other major change on the technology side is the adoption of mobile and social networks. Historically, if you launched a business and you wanted to acquire a lot of customers, you had to do nationwide ad campaigns, TV, newspapers, all things that used to be extremely expensive and not really agile. Today, with social media, with mobile, you could hyper-segment your customer targets and really go after them at actually a very low and variable cost to prove out your model and to prove out how you're going to acquire these customers. This significantly reduces the cost of building a platform. Looking at changes in financial services, there are a few things that have further de-risked the entrepreneurial position. First is regulators. Regulators globally are pushing for transparency and customer fairness. They are moving from a purely prudential lens to one of customer focus and fairness. This is especially seen in places like Europe, in the UK, with many of the movements that were mentioned by Rob this morning on open banking, GDPR. You see a wave of customer focus empowering the customer to make decisions when it comes to their financial lives. The other thing that has dramatically changed is the financial crisis shook people's confidence in traditional financial services brands. And on top of that, multiple scandals of kind of mis-selling across the world has shaken people's trust in who they traditionally invested with. This is very important because it drives an openness to new business models. And this change in regulation and this change of trust paired with the user experience that an Amazon has made available to so many people has changed the consumer's expectations. Consumers today want to be able to buy financial products when they want it, how they want it. And that is essential. And a lot of financial institutions have not yet adopted that new model of interaction. When people think digital, they often just digitize their forms and fail to realize that digital actually means an entirely new customer flow. Customers all around the world, Canadians, are more open to alternative models. That's on the risk side. Ultimately, the risk of launching has fallen. The reward has dramatically increased. Over $60 billion of funding went into fintech over the last 12 months. Thousands of paper millionaires have been created across the world. This is a tremendous reward that is motivating a lot of people to start fintechs. And you could see the plethora of companies being launched. I mean, everybody knows of the famous Wells Fargo slide where every part of their business model is being attacked. This is true of all financial services. This cocktail is leading to an explosion of new companies and, in our minds, opportunities. This is all taking place in the context where change is becoming exponential. Not only are the number of new innovations growing rapidly, but the time it is taking for people to adopt those innovations is significantly shrinking. If you look at this chart, it took 46 years for a majority of the population to adopt electricity, which is quite interesting. It took a matter of months for Pokemon Go to be a global phenomenon. And you got to wonder, which one solved the bigger need? Companies at the turn of the 19th century could afford to be slow followers. Companies in the second half of the 20th century could afford to be fast followers. Today, I wonder if scale and network effects make being a fast follower much more challenging, and whether incumbents need to be actual leaders in adoption of new technologies. In this context of opportunity and exponential change, both incumbents and fintech face major challenges to ensure their long-term success. Starting with incumbents, most are struggling with legacy. Legacy systems, legacy customers, legacy worldviews. Addressing these require major change management efforts, which is never easy. Many of the business models that incumbents have historically had rely on fee structures that will be challenged over time by innovators, but also by regulators. Some will struggle to attract talent because a lot of talent wants to build rather than renovate. All will struggle with the perceived cost of failure. And this, if I look at our own platforms, the perceived cost of failure in large groups is so high that a lot of people are not willing to take the risk, because the risk reward in a large corporate environment is just not where it is for the incubators, for the innovators. Startups face a very different set of challenges. Challenge number one, they got no customers, both on the B2C and the B2B side. On the B2C side, the biggest hurdle to acquiring customers is trust. It's very hard for people to trust a Wealthsimple with their life savings. It takes years to build that trust. And if you can't build that trust, odds are you will have a prohibitive customer acquisition cost, making it impossible for you to scale. On the B2B side, long sales cycles make it very hard for companies to survive long enough to actually land their first customers. It is very hard to sell a B2B product because, someone once told me that in a large institution, there's about 100 people that can veto the project. The CEO may say, hey, we're going that way, but the bus will just keep on going straight. And it's very frustrating for the CEO and it's very frustrating for the startups, but it's the reality of big organizations. The second challenge for startups is lack of capital. The reality is that there's a lot of VC capital out there, but a lot of it is not timed. It doesn't have the right time horizon and doesn't necessarily have the right quantum. Because in fintech, the lead times are going to be long and the quantums needed to acquire many customers are going to be large. The third challenge for a lot of fintechs is a lack of network. The reality is that the way entrepreneurs often build companies is they see a pain point in their day-to-day lives and they go out and they try and launch a company that's going to solve that pain point. The reality is that people that have launched companies to try and solve financial services pain points don't necessarily have financial services experience and therefore don't have the networks with other financial companies or regulators. I look at Wealthsimple. The management team at Wealthsimple, prior to doing Wealthsimple, had launched basically a company called 1,000 Memories that was sold to Ancestry.com, and they were in the business of tracking people's ancestry, which is totally different from financial services. These challenges are further accentuated in Canada. You know, ultimately, Canada has an even greater challenge to become a leader in fintech. And as a result of having a challenge in being a leader in fintech, I worry that our large financial services institutions will also be challenged to become global leaders. Because as Janet Yellen said yesterday, fintech makes large groups better. Without fintech and without fintech champions in Canada, I worry that our large corporations, our large champions like RBC, CIBC, BMO, whatnot, will struggle to be true global leaders. And for Canada, we need strong global leading financial institutions. Just looking at the world in a very simple way, you see that Canada has no unicorns. You know, the US has unicorns, China has unicorns, the rest of the world has many unicorns. There are many fintech unicorns that have emerged across the world. Canada currently has none. You know, why is that? You know, ultimately, I think of two reasons that are really important in terms of helping Canada actually develop fintech champions. One is there's a need for regulatory and policy changes. We need to follow a lot of these other geographies and adopt some of the regulatory movements that have taken place in those geographies. In terms of regulatory recommendations for Canada, I have three areas of policy focus. One is there's a need to create a national regulator for fintech while maintaining the traditional regulatory bodies for the rest of the industry. It's important to have a national regulator for fintech because fintechs are interacting with customers in ways that are very different from what has happened in the past. You know, Rob earlier this morning was saying most people want to text. The reality is a lot of the regulatory rules call for an actual voice telephone call to open an account, or in some cases, an actual wet signature. The reality is that, you know, when you sit in the Wealthsimple call center, and I did that for a day, the phones never ring. The only phone call that was received when I was in the call center was a prank call to me. And so, you know, the phone doesn't ring. At Personal Capital, which had a business model where you basically look at all a customer's assets and you actually target via telephone sales force those customers and try and serve them, onboard them, we found in the last 24 months that the willingness to accept telephone calls is falling significantly. We need regulators that can be up to speed and understand these changes in customer preferences. We need to adopt the open banking movement. Things like GDPR, the ability to empower customers to have their data and to move from one account to another is extremely important. The friction to competition in financial services in Canada is high. We live it every day at Wealthsimple when we try to kind of have clients transfer accounts from traditional institutions to our company. Finally, the third area of recommendation is we need a significant rehaul of the payments infrastructure of the country, and we need to grant wider access to that payment infrastructure. Ultimately, the payment rails will become information highways, and if we do not have a wider set of companies having access to that information highway, they will be at a significant disadvantage relative to those that do. The second non-regulatory point is more a structural one about Canada. We're a small market. I mean, the reality is that not only are we small, but we're siloed. You know, it is hard for startups to launch across Canada and in Quebec. Different languages, different approach. You know, we are a siloed country and we're small. We're small not only in terms of number of people, but we're actually small in terms of number of financial institutions that many can partner with, which is why many B2B companies in Canada tend to land some of their first partnerships in the US. You know, this is a challenge because given the concentration of financial services in Canada, you often don't have the incentive to take risk. I mean, you look at, we were talking about JP Morgan this morning, they voluntarily adopted open banking. The reality is that they have no choice because they're competing against 3,000 other financial institutions. That is a major difference between Canada and the rest of the world, which is why policy and regulation are going to be very important. Beyond regulatory change and the reality of our small market, I believe that there are two key elements to creating the next generation of financial services companies in Canada and internationally. The first is partnerships. Partnerships between fintechs and incumbents, partnerships between fintechs and fintechs. The second is segmentation and customer focus. Never has segmentation become more important. We've often, as an ecosystem, asked ourselves these three questions. Will fintechs figure out distribution? Will distribution figure out innovation? Who will be the first to partner and create partnerships between distribution and innovators? Media often speaks of fintech having moved from disruption to enablement, moving from box 1 to box 3. The reality is that I believe that all of this is going to happen. And most important, I believe we're going to see more and more partnerships between fintechs. If you look at the partnership between Coho and Wealthsimple, between N26 in Germany and Clark, between Revolut in Europe and Wealthsimple, you're going to see more and more partnerships in the fintech space, enabling fintechs to acquire customers at a faster rate. But ultimately, I believe that incumbents will not be able to evolve their business models fast enough without partnering. And those that succeed at forming these partnerships will, in the end, become winners. And by partnership, I don't mean acquire. You know, a lot of large financial institutions are like, hey, we're going to partner with this thing and then we're going to acquire it. You know, that is not the way to do it, because ultimately what you want to do is keep your options open. You know, partner, see if it works, and keep your options open to basically find the best partners for your clients at different stages. In terms of segmentation, this is a very crude drawing of the segmentation of Canada. But if you look at, for example, the big five, banks that basically control 80% of Canadian kind of wealth management, this is the three channels through which they kind of access this is the way they access their customers. And ultimately, we believe that this is part of the key to the opportunity in fintech in Canada. Understanding who you are best placed to serve in terms of your customer segment, and focusing your product delivery and service to basically deepening that relationship is going to be critical in a competitive environment where consumers have more and more choice. This touches on the question at the opening. You know, why are all of us here customers of the banks, but none of us really love the product other than some of the tables over there? It's because the banks have built a model to serve all of us, to basically bring services to all of us. But the problem is, by building a product that is good enough for all of us, they've not been able to build a product that is great for any of us. And that is very important. And that's partly because they're organized by channels and by product silos. And ultimately, as a consumer, it is very difficult to travel from the retail channel to the broker channel to the private channel and back. In the same way that if you have a mortgage, odds are the guy at the credit card doesn't have the same information. If you have a US account with a bank and a Canadian account, none of them talk. I'm sure all of you guys have experienced this. It's just a reality of being an incumbent institution. You know, Rob Glasky mentioned this morning that there's going to be a reorganization of the value chain in financial services, where companies are going to go from product organizations to platforms. We at Portage are major believers in that change. If you look at how we view the world changing, it's because ultimately we believe that companies are going to design more and more hyper-segmented products. The reason why so many people in this room are Wealthsimple clients is because many of you are exactly the segment we target. The reason why so few of you are Investors Group clients is because you are not the core Investors Group customer segment. And that is very important, is that ultimately, it's like, if people that are in their 70s, come to me and say, hey, I've not seen your Wealthsimple ads. It's because ultimately, a person that is in their 70s and in a rural area is not our core customer segment. And we are targeting people that are between 20 and 50 in urban areas that are professional services employees. And the reason why you love the product, or so many of you who have used the product love it, is because we've designed this product specifically for you. The digital channel allows platforms in the Portage ecosystems, platforms like Coho and Wealthsimple, to hyper-segment customers and deliver product experiences that align with their expectations. If you look at Wealthsimple, we ultimately target people that have between $10,000 and $300,000 of investable assets and that are under 55 years old. That is a very clear segment that tend to be highly educated and in urban areas. Everything we do is going after those segments. At Coho, it's a lower income demographic, but it's people that are on the move, people that are traveling a lot, small business owners. We basically deliver to them low fee, simple product. If you look at the success of fintechs historically, this type of segmentation and targeting has actually been the key to many of their successes. If you look at PayPal and their early success, they targeted eBay power sellers as their initial customer segment. And from there, were able to grow to become the behemoth they are today. Diving deeper into the Wealthsimple story, because this is actually the purest, demonstration of this. What does it mean to build a product for a specific customer segment? In our minds, it means aligning technology, product, and marketing to a brand purpose. At Wealthsimple, we have 4 brand pillars, 4 purposes. We look for accessibility, reduced friction, low fees, and education. Those 4 pillars are the basis of everything we do and our customer promise. We support these through 3 things: technology, product, and marketing. On the technology side, we are a technology-first company. 50% of the employees at Wealthsimple are engineers. This is really important because many of us in the large-scale financial institutions have historically viewed engineering as a back office cost. We've brought engineering to the front office, and that is a very important thing. Every single process, every single customer service is paired with an engineer who will code out customer issues so that customers over time will have less and less issues with the app. We embed engineers in every part of our process. We've also developed one of the most efficient back offices in the country. Our cost of service at Wealthsimple is, I would believe, probably lower than most financial institutions. We built a great product. Our product is simple, accessible, and affordable. The pricing is transparent. We always ensure we are authentic. And then finally, all of that is aligned with our marketing. We've invested a lot in our brand. We look to build trust through human stories. We have a promise that is simple and transparent. This all drives customer love and engagement. And customer love and engagement is absolutely essential to succeed in a world of fintech. 1/3 of our customers access our app every day, which is pretty amazing for a basic portfolio. If you look at where we're going, on the right, this is where we are today. We've basically built a customer relationship, and we're looking to deepen that relationship with products and services that are aligned with our brand and value proposition. Today, we have our basic automated investing account. We have a smart savings account where we've partnered with Equitable Bank with a lot of success. We've announced this summer the launch of Wealthsimple Trade, which is our commission-free trading platform, the first of its kind in Canada. Ultimately, over time, we will migrate to the left because as we've built this customer love, as we look to deepen our customer trust and engagement, we hope to be the trusted financial services provider for all a customer's financial planning needs. Over time, this may include mortgage and insurance. But as Rob was saying this morning, Rob from Deloitte, in the case no one knows who I'm talking about when I say Rob, ultimately, we don't need to own the mortgage. We don't need to own the insurance provider. The only thing we need to do is make sure that the user experience that these providers deliver to our customers is in line with the user expectations and our promise. And so over time, we will look to sell more products that are aligned in expectations and customer experience that our customers could benefit from. Given this opportunity, what are we doing at Portage? Ultimately, our mission is to connect opportunity with talent, capital, and network. To execute this mission, we announced this morning the launch of Portage Ventures 2. This is a $400 million venture fund with a promise to deliver to our investors strategic and financial returns. And we believe that actually both of those actually build on each other, where by having a group of investors that are our partners, we will actually able to deliver them strategic solutions via fintechs that historically have been much harder for them to access. Our promise to entrepreneurs is to invest, develop, and empower them to reshape financial services. We hope to give them the tools to win in their domestic markets, Canada and abroad. You heard from Clark in Germany this morning. We hope to empower these entrepreneurs to win in their local markets, but then give them the confidence over time to expand and become global champions. To execute this mission, we are going to be focused in 4 areas. Areas that we and our partners know well: insurance, wealth management, personal finance, and what we call the enabling layers. Ultimately, it is our belief that some of these enablers, AI, aggregation, blockchain, will end up playing a major role in the future of financial services. And these verticals, insurance, wealth management, personal finance, can significantly benefit from the help from these enablers. Again, we said that our mission is to connect opportunity with talent, capital, and network. We've built one of the deepest teams in fintech in Canada and one of the deepest teams in fintech in North America. And we believe that this team is essential to helping these entrepreneurs win. That this team is made up of many CEOs and many vertical experts that have scaled companies before. People like Nick Hungerford, who built Nutmeg in the UK, the Wealthsimple of the UK, is now our Singapore investment partner. People like Ron Close have been the CEOs of multiple companies in the past. I believe we have a winning team. We connect fintechs with our network. Ultimately, we have partnered with many of the top VCs in the world. Actually, last year, we were one of the most active VCs in fintech globally, and probably in our specific verticals of focus, the most active investor. And today, with the launch of our fund, we are probably one of the largest funds in that sector. We hope to build partnerships with all of you. The reality is that we are open for business with everybody, and ultimately, this is how we're trying to lead by example. A lot of people say, Power Financial, Great West, IG, you guys are conflicted. The reality is we are trying to be open for business with everybody. Anybody who wants to partner with our portfolio companies or with us, we are open to working with. We've deployed significant capital in the space. In the last 3 years, we've deployed over $250 million in the venture space. These are some examples of our portfolio, and ultimately, this portfolio builds on itself. The network continues to build. If you look at our investment in Allen, which is the leading health insurance disruptor in France, that investment led to Hellas Direct, which is a Greek auto insurer, to reach out and work with us. The ultimate embodiment of this mission of connecting opportunity with talent, capital, and network is in Diagram. Diagram is our Montreal-based accelerator. And this, in my mind, is one of the most exciting things happening at Portage, and one of the most exciting things I think happening in fintech in Canada. At Diagram, the Diagram and Portage teams ideate on exciting business models to bring to Canada in financial services. Once we have an idea, we pair that idea, that opportunity, with a great leader. And the quality of the leader, the qualities we look for in a leader are 3 things. They need to be able to attract capital, they need to be able to attract a team, and they need to be so passionate about the business we're about to launch that they can't sleep. That is absolutely essential, because when times are hard, if you are not mission committed, it gets really hard. Once we have an idea and a leader, we actually help that leader recruit a team. In Montreal, over the last 24 months, we've hired 400 people for Diagram startups. We've founded 5 companies in the last 24 months. Our goal is to found 14 more in the next 36 months. That is a massive recruiting machine. We have 7 people that do recruiting full-time and create significant employment and opportunity in Montreal and hopefully over time across the world. We then pair that with capital. We invest $4.5 million in each one of these startups of our capital and 50 angel investors that have founded Diagram with us. And this cocktail, I believe, ends up creating a lot of excitement. And ultimately, we pair all of that with our network, and we help accelerate business models. So an example of that would be Dialogue, our telemedicine company. I hope a lot of you are Dialogue users. But ultimately, Dialogue is now the leading telemedicine company in Canada. We founded it 24 months ago, and it's the exact example of this business model. In conclusion, as I mentioned in my introduction, I believe there's a generational opportunity in FinTech. That opportunity is best captured by an approach of taking segmented views and being open to partnerships. At Portage, we are looking to capitalize on that opportunity by connecting the best entrepreneurs with capital, talent, and our network. We believe that we will end up delivering to our investors industry-leading returns and partnerships. That is our story, and I would challenge you to build yours. Thank you.